Ladies and gentlemen, welcome. This is Christopher Aaron. This is a special presentation. Immediately following this video will be a second video covering the regular analysis that I do on the current action in gold and silver. However, I've been getting a lot of requests. A lot of people are really interested in what may happen after this Federal Reserve meeting that is coming up on the 16th of December. There's a lot of speculation that there may be a rate hike, and I want to give some analysis on what I see as the potential for the rate hikes that may be coming. So stick with me. After this, there will be that separate video on the current action. So we're here looking at the Federal Reserve. This is the building in Washington, D.C., the next meeting coming up on the 15th and the 16th of December. Now, the market is pricing in the chance of a rate hike for the short-term interest rates that the Federal Reserve controls. However, this is not the first time the market has been pricing in such a rate hike, and the market has been wrong for the last several years. So let's just be clear, we don't have it confirmed. We are not certain that a rate hike will be coming. But we want to analyze what may happen, whether it's this meeting or the next meeting, or sometime in the next year when these rate hikes begin. Of course, the Federal Reserve, being a private organization that controls the issue of our currency, and we can see here the job that it has done. Being a private organization, it is owned by its member banks. And so when given the choice between printing money to bail out the banks or a stable currency, we can very clearly see here that the Federal Reserve chooses to print money to give to the member banks, to give to the Treasury, to spend into circulation, which is what causes this decline in the purchasing power of the dollar. Now, the Federal Reserve, as we know it, is not the first time that the United States has tried a central bank. The first one was the First Bank of the U.S., as it was titled, which was started in 1791, lasted 20 years, and failed. The Congress dissolved it because it destroyed the value of the currency and failed to stop inflation. It was tried again a few years later, and the Second Bank of the United States was dissolved 20 years after that in 1836. So we lived without a central bank in the United States for almost 100 years until 1913, when the Federal Reserve was founded in its current form. We can see it's mostly on the same path that the previous central banks have taken. But thus far, the organization has lasted over 100 years. So I'll get off my soapbox and look at what the actual market action of the Federal Reserve has been. We are looking here at the federal funds rate since the Federal Reserve has been in control of this rate since 1955, which is the short-term interest rate. This is the interest on loans that banks make with one another that are typically overnight loans. And the Federal Reserve, being the lender of last resort, has a mechanism by which they control this interest rate. And the short-term interest rate plays a role in the subsequent interest rates that go out the yield curve, the 30-day loans, the 2-year Treasury bonds, the 10-year bonds, and the 30-year bonds. They're all related. And the Federal Reserve, the way that it impacts these short-term Treasury rates is by, can you guess it, printing money. So keep in mind that when we talk about the Federal Reserve impacting these rates, it doesn't just have a lever that it presses to change the rates. What it does is it prints money to buy short-term bonds. And by buying the bonds, it drives down the interest rate. Interest rates and price for bonds being inversely related. So keep that in mind whenever you hear in the news that the Federal Reserve is lowering interest rates. It is printing money to do so. So we see where we are right now for the last 6 years at 0%. And I've spoken about this a number of times. Completely unprecedented in the history of this central bank to have interest rates so low. Now, there have been other times that it has suppressed interest rates below what the market would normally dictate. For example, here in the early 90s, which was after the savings and loan crisis in the United States, and the central bank came in and printed money to suppress interest rates and to help out some of its member banks that were in trouble during this crisis. So what happened with all this printed money is a few years later, in the late 90s, we had the NASDAQ bubble. So all this money floating around in circulation has to go somewhere. And in the 90s, it went into the NASDAQ bubble. The NASDAQ bubble burst, and we entered a recession, shown by this gray line, in the early 2000s. And what happened after that? Well, to solve that crisis, the Federal Reserve printed more money, lowered interest rates even further in the early 2000s. And what was the result? The housing and subprime bubble, which led to the largest world financial crisis we've seen in our lifetimes, as bank after bank failed, having loaded up on all this toxic debt. So what did the Federal Reserve do again? They printed even more money, and they lowered interest rates even further, which brings us into the present. As I've said, this big question mark here as to what is going to happen with all the money that's been printed that is sloshing around in the system. This remains to be seen. This is for a historic background on the cycles of interest rate manipulation by the Federal Reserve. And let's not forget here that in the 70s and 80s, short-term interest rates approached 20%. 20%. And that was in response to the inflation that was showing up in the system after the Vietnam War and the social spending that was going on in the 60s. So there is a precedent here for much higher interest rates. Now, this is where a lot of people become afraid when they are thinking about gold, because there's a myth out there that when interest rates rise, gold will fall. And I want to look at a few specific time periods here to discuss what actually happens when interest rates rise via the Federal Reserve system. So here we're looking at one of those periods from 2003 through 2007, when rates rose from 1% to 5.25%. As we know, this is what led to the collapse of the housing bubble. But what happened to gold during this rate rise? There's the answer. Gold rose from roughly $300 an ounce to $850 an ounce over this same time period. So here we can see that rising interest rates corresponded with a rise in gold price. And of course we know that silver followed gold, although it was more volatile in both directions, as it always is. So keep in mind, if you're a silver investor, silver following the price action of gold for the most part. Let's look at another example. 1955 to 1980. Okay, this entire multi-decade period with some rises, some falls, some rises again in the short-term interest rate, up until that super high level of almost 20%. So we're looking at this whole time period of rising interest rates. What happened to the price of gold? Did it fall? No. So rising interest rates corresponded with a rise in gold price. Of course, this being a monthly chart here showing gold from 1955 to 1980, showing the peak at slightly below the daily peak, which was 850. This being the monthly peak, right below 700. But the trend is clear. You just can see here these two charts. As interest rates have been rising, gold rising over that period. So we have two examples like that. Let's look at another time period, 1980 through the present, where we've been in a falling interest rate environment as a whole. Here's our long-term gold chart. So I want to bring attention to this time period right here over the last 10 years. We've had falling interest rates and a falling gold price until the early 2000s, after which gold began to take off and has, for the last 4 years, been in this bear market. So what's going on here? This is a very historically unprecedented time period where you've had gold rising even as these rates were falling. We showed in the last 2 pages that gold typically rises as interest rates are rising. The answer, I believe, is gold is signaling something. Gold is acting as a thermometer. Gold is warning us that something is brewing in the currency markets. So you had this rise in interest rates from 2003 to 2007, and gold had this massive rise, which continued beyond 2007. And then, yes, interest rates fell and have been held down, and gold has fallen for the last 4 years. However, it hasn't fallen all the way back down to where it was when it started this rise. So the thermometer analogy means gold is letting us know here that something is brewing, that perhaps this generational cycle of lower interest rates is coming to a close, and that at some point over the next several years, for perhaps a number of years after that, we are going to see interest rates rise. And as we showed in the previous 2 slides, rising interest rates correspond to rising gold prices. So it looks like we are getting that signal here, a warning ahead of time from the gold market that at some point in the near future, these interest rates are going to reverse. Of course, reversing interest rates corresponding to a falling of the bond prices, which will be one of the most significant events for us to witness, as bond prices have not fallen for over a generation. So there's my analysis on the upcoming potential rise in interest rates. And stay tuned for the next video. It's going to cover how this plays with the current action in gold and silver up through the last week. Thank you again for joining me. See you on the next video.